Nobody has ever enjoyed renting a car. You land, drag your luggage onto a bus, and then stand in a line that hasn't moved in 30 minutes while a single agent tries to upsell every customer for insurance they already have. When you finally get to the counter, the car you booked weeks ago is mysteriously unavailable, but there's nicer ones they'd love to upgrade you to for a fee. You sign a stack of papers that no one has time to read, decline 20 different add-ons, and get handed the keys to a car with crumbs and scratches that no worker will admit is there. Then, after your trip, the real bill lands, and it's somehow double of what they quoted online, with upcharges and penalties for dings that you never saw. Even though you took hundreds of photos of the car before and after, you now spend weeks trading emails to contest the bogus charges, only for both sides to eventually discover that the damage was caused by a different renter or that accounting simply billed the wrong person. It's tempting to blame it all on greed, but the experience has been like this for decades, and the truth is that it's baked into the economics. The reality is that rental cars have always been a bad business, with margins as low as airlines in good years and as thin as grocery stores in bad years. And in their best years, they make more selling cars than they do renting them. The cost-cutting, barebones service, predatory billing, and inconsistency of modern car rentals all stem from the same rotten unit economics. The industry has never had a golden age where consumers can look back on with nostalgia. And for all the talk about technology and disruption, that's never worked either. Startups like Turo, which dropped the crushing debt, extreme overhead, and crippling liabilities of rental fleets in exchange for asset-light, peer-to-peer sharing, all net the same tiny margins. Through history, car rental companies have always been treated as strategic assets rather than healthy, standalone businesses. In the 50s, the fast-growing industry was seen as a high-growth, critical infrastructure for modern Americans, just like how movie theaters and airlines were perceived at the time. With fleets of tens of thousands of vehicles, their assets and scale were valuable to anyone who wanted a stake in post-war travel. Hertz was passed around through generations and by the 80s had gone through the hands of NBC, United Airlines, and Volvo. Avis bounced from an investment bank into Sheraton Hotels, Hunt's Ketchup, and the parent of Tropicana and Orville Redenbacher. National ping-ponged between Boeing and HSBC. Regardless of if it was telecom, food, defense, finance, or airline, none of these conglomerates could make the numbers work and offloaded these rental companies within years of their acquisition. By the 90s, the big rental giants had landed with the one group remaining that would want them, the big three American automakers. Ford took Hertz. General Motors took National and Avis, Chrysler took Dollar and Thrifty. Only Enterprise and Alamo stayed out of the automakers' hands as private, independent operators. Because these brands had been bought and sold across so many industries over much of the 20th century, there was little for antitrust regulators to object to. But not even the automakers could stomach the rotten unit economics. One by one, they divested, having learned firsthand that the rental business was far worse than assumed, and that the rental companies needed automakers far more than the automakers needed them. With no conglomerates willing to shoulder their overhead as private subsidiaries inside larger empires, the rental giants had no choice but to find their future alone with public investors, much like the movie theater chains before them. Chrysler had been the first to exit, combining Dollar and Thrifty in a single IPO back in '97. Ford offloaded Hertz in the early 2000s to private equity, the only buyer still willing to touch such a perennially distressed asset. The PE firm loaded Hertz with even more debt and flipped the company onto the public markets in less than a year. In the same period, Avis was cut loose with its own IPO. By the time the dust finally settled in the mid-2000s, the world got to see just how unattractive the car rental business really was. Since then, the industry has only fallen further for investors and consumers alike. The business is so structurally flawed that the only way to wring out margins is to squeeze it out of customers by nickel and diming every add-on and fee to generate profit that the model itself can never deliver. In this episode, we break down the horrifying business of car rentals, from Avis and Hertz to Turo, and explain why no one has ever managed to disrupt this industry, and why no amount of technology can save a business model this broken. From the outside, car rental shouldn't be this hard. The business is absurdly simple. You buy or lease cars, park them in a lot, and then rent them out daily for as much as you can get. The underlying asset is commoditized, and service is non-critical. Anyone with enough money can do it. Most industries build moats on expertise, brand, or technology. But in car rental, the only real barrier is capital. You're only as competitive as the cars you have, and no amount of 5-star customer service or slick marketing will win you a booking if you don't have the cars people want at the price and availability that they want them. The cars are the entire business, and while capital gets you in, it buys you no edge at all, because the money gets you the same cars as everyone else. The deeper problem is that cars are depreciating assets that lose value the moment you buy them, and they continue to bleed value whether they're earning on the road or sitting idle. Renting it out is the only way to claw back the money you paid for the car in the first place. But renting also accelerates the depreciation that it's meant to offset. The more you rent out a car, the more you earn, but the more miles it logs, the harder its value falls. Conversely, if you rent it out less to protect that value, you leave money on the table while time eats the car anyways. A natural question at this point is why sell at all? Why not run the cars into the ground the same way that taxis, truckers, couriers, and bus drivers do, and wring every last mile out of them? A car rental company can't do it for two reasons. First, the best margins will always be renting out the newest models with the lowest mileage. These are the cars that consumers want, and they'll willingly pay that premium for their business trip or vacation. The people willing to risk their time and money rattling around on the cheapest, most beat-up, high-mileage clunkers are too few and too low margin to sustain the business. As a result, a car rental must constantly refresh its fleet with the latest and greatest models to stay relevant and hold on to its most valuable customers. At the same time, as cars rack up in mileage or age, they fall out of warranty and lose their reliability. Like depreciation, car reliability is an exponential curve. The older the car gets, the more expensive repairs will cost, and the more likely it will break down. A car stuck in the shop is one that isn't earning and bleeds cash and value even faster. As a result, it's far more efficient to buy new cars than it is to fix old ones. And the only way to afford new cars is to sell the old ones and roll whatever they can get into new ones over and over again. In contrast, if the cars were run all the way into scrap, the company would still have to find the cash to front the full price of a new fleet every single year. Under this lens, car rentals from the inside are like hedge funds that happen to specialize in cars. They hold billions of dollars of cars as assets, fund purchases with debt, earn as much rent as it can over the next 2 years, and then sell them all before their residual value and reliability plummet, and then repeat this annually. Everything rides on two numbers, utilization and residual value. Utilization is efficiency. How many of these cars are being rented out at any given day and at what rate? Residual value is how much the same cars are worth in the used market when it's time to sell, and the challenge is to time that sale as close to the peak as possible. If you nail both, then the rental income, used car sales, insurance upcharges, and add-ons will cover the next fleet, and any money left over is your profit. But if you have too many cars idling and miss on utilization, or sell too late when the used car market is soft and fetch low residual value, then you'll lose money. And if you run the cars to scrap, then both sides of the business collapse. Thus, it's not only about price, but also liquidity. The older and more worn out a car gets, the harder it is to sell. Anything beyond that 1 to 3 year window, and the pool of buyers disappears. As a result, holding on to cars for too long costs you twice. You lose not just residual value, but also the liquidity necessary to fund replacements that will objectively earn more and cost less to run. Another natural question at this point is then why not optimize for the most reliable cars, like Toyotas or Hondas? If your fleet is reliable and is cheap to fix with mechanics and parts on every corner, then surely the economics will improve, but it doesn't work that way. Japanese cars hold their value far better than American or European ones, but that's exactly why they cost more to buy in the first place. The strong resale value is already priced into the sticker. You pay more upfront to get more back later, and the difference washes out. The cars with the best residual values are the ones you can't get cheap, and the cheapest cars to put in a fleet are the least desirable ones, not the most. This equation of residual value and utilization is why the industry's bet on electric vehicles became such a disaster. In the early 2020s, Hertz ordered hundreds of thousands of Teslas, committed to buying even more from GM, and poured money into charging infrastructure. Avis played it more cautiously and got burned just as bad. Utilization was inherently poor because the cars were so hard to fix. Teslas are so vertically integrated that ordinary mechanics couldn't service them. Parts were scarce and available only through the manufacturer, and the battery, the most critical component, could be easily damaged in a minor collision. Repairs cost twice as much and took twice as long as gas cars, which resulted in more cars sitting in the shop instead of out-earning. Yet it was residual value that was the bigger disaster. The rental industry had been swept up in the optimism of the early 2020s and believed in the widespread Wall Street narrative that EVs would get cheaper, go further, and hold their value better than gas cars. Yet the opposite happened. EVs ended up depreciating twice as fast as gas cars, and the widespread concerns and documentation of battery degradation and range loss crushed demand in what everyone had expected to be a booming used market. At the same time, Tesla and other EV makers slashed the prices of their new cars repeatedly to prop up demand as interest rates spiked, Chinese rivals surged, and the US government imposed price caps for tax credits. Every markdown to a new Tesla tanked the value of every used one and hurt the tens of thousands sitting in Hertz and Avis lots. The theoretical depreciation curve that they'd been trying to stay ahead of was ripped apart by the automakers above them. With plummeting utilization and residual value, Hertz lost $200 million, while Avis lost $500 million on EVs alone. But even if there was a perfect car, one that was incredibly cheap, reliable, easy to fix, and carried high residual values, it still wouldn't matter. Every rental company would pack its lot with that same car, and that product advantage would vanish instantly. You would fall right back to renting the same cars as everyone else at the same thin margins. The type or performance of a car is really only an edge for the automaker, and not for the rental company that provides a commodity service. Thus, residual value and even utilization to some extent is in the hands of automakers rather than rental companies. What's worse is that all purchases are forward-looking bets on demand. Avis and Hertz can't walk into an automaker and order 1,000 of a specific model for delivery next month. They must forecast demand a year in advance and commit to that order long before customers show up. Ultimately, every input that decides their fate is set somewhere else. The price rental companies pay for new cars is set by automakers. The price they recover on used ones lives in an entirely separate market, set by consumers, wholesalers, and automakers all at once. The cost of debt for new car purchases is set by the credit market and interest rates, and the end consumer demand rises and falls with the broader economy as air travel, employment, wages, inflation, and auto loans all influence the need for rental cars in the first place. Every rental agency is at the mercy of these 4 separate markets. To complicate matters even further, each of these 4 markets are cyclical. They fluctuate based on timelines and real-world events that no one can predict. New car supply floods one quarter and then dries up the next. Used car prices can rocket to highs one year and collapse the next. Borrowing can go from cheap to expensive overnight with Fed hikes. Travel can dry up in one season and surge in the next. These markets are inherently unstable because the events that move them, like a pandemic, a chip shortage, a travel restriction, a mass recall, or a rate hike, can never be timed. Thus, rental companies are placing leverage bets every year in advance across 4 markets and need to hit every single one to make profit. The depreciation curves that they use to decide when to buy and when to sell is ultimately just theoretical. This is why car rental has always been such a brutal business. The other problem beyond the macro level is that the actual day-to-day market that rental companies compete in is just as broken. Airlines, movie theaters, and hotels all defend their pricing power by locking down territory and holding the real estate, locations, and routes that keep competition out. Rental car companies have no such play. Their product is equally as perishable. An unrented car is like an empty airline seat or unsold hotel room, where the cost of ownership is already sunk and the marginal cost of an additional customer is near zero. Every player, from Avis to Enterprise, is under constant pressure to cut prices. A booking at almost any price beats an empty car that earns nothing, and across a fleet of tens of thousands, that revenue can meaningfully offset that day's depreciation. The distinction here is that this pressure arises from the business model rather than from the competition. Pricing is really the only lever that rental agencies control, and so every player, even when left on their own, must resist the temptation to discount in order to maximize utilization. And whenever one giant cuts, the others match within hours, which means the big 3 operate exclusively between 2 states, an all-out price war at one end or tacit collusion at the other. At the same time, while airlines can at least fly their planes to wherever demand is strongest, and movie theaters can flex showings and staff to match demand, a rental car can do neither. To cover the weekday peak, those same cars sit dead on the lot all weekend. This is why airports remain the strongest, highest margin, and most coveted venues in the entire industry, as the one place where these dynamics don't apply. With corporate travelers paying out of expense accounts and walk-up travelers deplaning in a hurry, the audience is uniquely captive and price blind. Entry is restricted by the airport itself, as a rental company must bid to get a spot, squeeze into the shared facility with its rivals, and hand the airport a tenth of its revenue, along with minimum annual guarantees. These barriers keep new entrants out and hold an implicit price truce in place between Avis, Enterprise, and Hertz. But outside of the airport, it's open season. Customers shop on price and the big three tear each other apart. This kind of moat only exists at airports because of their regulation, and every attempt to recreate this elsewhere has failed. Zipcar in the late 2000s was hyped as a disruptor that would pull the legacy daily rental business away from mature, contested airports and into mass-market urban neighborhoods. With an app, self-service, and a membership model, the startup promised a better business built on deeper utilization and greater consumption frequency, where cars would be rented by the hour rather than by the day. Avis acquired it in 2013 for $500 million, adding fuel to the narrative that urban car rentals were an untapped market and that Zipcar would be a billion-dollar brand as a modern digital hedge against the legacy airport rental business. Now, over a decade later, none of it came to pass. Zipcar's unit economics turned out to be far worse than the traditional model. Hourly rentals made high utilization nearly impossible, and because members needed to return the car to the exact spot they took it from, Zipcar could only ever serve the people that lived right there. The service was a luxury rather than a utility, and viable only in a handful of dense, affluent urban neighborhoods. The acquisition has been a catastrophe, as Avis today barely mentions Zipcar, has shut down the service in the UK, and has quietly scaled back its domestic operations. We talk a lot on Modern MBA about market leaders and the moats that protect them. Right now, it's said that every day your business is late to AI, you're falling 2 days behind. But how do you keep up? The competition is only moving faster. Fortunately, there's NetSuite Next. You already know NetSuite. It's the gold standard AI-powered business management suite that brings your financials, inventory, commerce, HR, and CRM into one single source of truth. NetSuite is trusted by over 43,000 customers and securely connects all your data. NetSuite Next is the next generation and an evolution in how your business gets done, because AI is built into everything you do. NetSuite Next automatically surfaces custom insights throughout your day, deploys AI agents to work alongside you to solve problems and handle your routine work. Anytime you have a question about anything, just ask, and it'll answer, just like you're having a conversation with a colleague. Like NetSuite, NetSuite Next is built from the ground up to be customizable for a wide range of industries, so it supports the way your business works rather than the other way around. Whether your company earns millions or even hundreds of millions, it's time for NetSuite Next, where your business meets AI. At Modern MBA, we take great pride in our accuracy and originality. We don't use AI to write scripts, do research, analyze data, and we certainly don't trust them to handle our accounting, finances, and payroll. But NetSuite Next is completely different. It's AI built from the ground up by businesses, for businesses that are serious about getting to the next level. Once Modern MBA scales to that 7-figure milestone, we plan to adopt NetSuite Next ourselves. For the first time ever, you can try NetSuite Next for free. If your revenues are at least in the 7 figures, go to netsuite.ai/modernmba. That's netsuite.ai/modernmba, built for every industry, ready for every boardroom. Thank you to NetSuite for supporting Modern MBA and making this episode possible. With all these structural problems, the only remaining question is, how did any of these companies survive? How did the industry make it through the 20th century, even when propped up by various parent companies, if the economics were this broken from the start? The reality is that for most of that history, they weren't following the equation we've described. The impossible balancing act of utilization and residual value across the new car market, the used car market, the capital markets, and the rental market all at once is a relatively modern development. In the decades prior, a rental company only needed to optimize for utilization. Residual value was someone else's problem, and that someone was Detroit. No rental company buys cars with its own cash. A nationwide fleet of tens of thousands of vehicles costs hundreds of millions, and for Hertz and Avis, it's billions. No company on the planet has that kind of cash lying around to sink into depreciating assets. As a result, the legacy giants finance purchases with debt secured against the cars themselves, borrowing 70 to 80% of the cost up front and putting up the remainder with their own money. Multiply that by hundreds of thousands of cars, and you get a rolling mountain of debt that's collateralized by the fleet itself. If the rental agencies stop paying what they owe or default, then the creditors can seize the fleet and sell off all the cars to get their money back. But financing is the simple part. The harder question is who's responsible for depreciation. As we covered, a rental company only wants to use a car for its first 2 to 3 years and then be rid of it. A conventional auto loan doesn't work because it's designed to end in ownership. Consumers pay down the cost of the car every month over years until the title is theirs, which is exactly what rental companies are trying to avoid. A lease is designed for people who want to drive a new car for a few years and then walk away. It shifts residual risk onto the automaker. The manufacturer commits upfront to a number it thinks the car will be worth in 3 years and then eats the loss if the car fetches less than that at auction. Automakers do leases carefully because they can spread risk across hundreds of thousands of individuals, models, regions, and end dates. But it doesn't work if one buyer wants to lease thousands of the same car, same model, and same year, and will eventually return all of them at once in a single afternoon. Ultimately, all the rental companies wanted was the timelines and protection of leasing, where the problem of depreciation and residual values could be offloaded to someone else at scale. That way, they could focus exclusively on utilization. Detroit solved this problem by building an instrument exclusively for the rental industry called program cars. Hertz and Avis got to buy vehicles in huge volumes straight from GM, Ford, and Chrysler. They still exchanged cash for title. But inside every sale, the big three automakers bundled a special contract where they promised to buy back those same cars at a fixed price on a future date, so long as each vehicle was returned in good condition and under a certain mileage. Sometimes the automaker took the car back as obligated. Other times, it had the rental company sell the car itself and wrote a check for the difference between what the used market paid and the price it had guaranteed. Either way, the outcome was the same. The automaker set the residual value and absorbed the loss if the car turned out to be worth less than it had promised years earlier. By buying back the cars themselves in the future, the automaker believed they could control the used market. If the rental companies were allowed to dump hundreds of thousands of cars whenever they wanted, then they would destroy the value of their used cars and new cars entirely. On paper, it was meant to be a win-win, where rental companies got to buy thousands of cars below sticker price and carry zero depreciation. They knew their costs the day of delivery and set rates against that exact figure. And whenever demand softened, they could hand back the cars early and shrink fleets without swallowing a loss. The other half of the modern business in predicting residual value, timing the sale, forecasting depreciation, and staying on top of the used car market simply didn't exist for the rental giants. This worked for decades, as through the 80s, 90s, and 2000s, Hertz, Avis, National, and Alamo fleets were overwhelmingly program cars, and their businesses looked stable. But in reality, these companies were being subsidized by Detroit. The real question is, why would America's biggest, most powerful car manufacturers agree to a losing arrangement where they held all the downside? The answer, as usual, was Wall Street and unions. Detroit in this era was addicted to volume. GM, Ford, and Chrysler measured themselves on units sold, and so did their investors, who treated raw sales volume as a scoreboard of popularity. The only metric that mattered was growth. Rental fleets were the easiest way to inflate volume. An automaker could book hundreds of thousands of cars to Avis or Hertz as sales in a single quarter, and then defer the residual loss for years. It was growth by accounting, where volume got pulled forward and costs got pushed out. The second reason was labor. Workers at the big three were fighting factory automation that would improve efficiency but also eliminate jobs over time. To appease the unions, the automakers created Jobs Bank, a program where workers who got laid off would still be paid 95% of their wages plus full health benefits. This single-handedly turned labor overnight from a variable cost to a sunk cost. An idle factory suddenly cost the same as a running one, because workers got paid whether or not they were sitting at home or working in the factory. This completely wrecked all common sense. Instead of cutting production to meet demand, the only rational move for automakers was to keep the lines running all the time because stopping saved nothing. As a result, Detroit kept building cars that nobody had ordered. It couldn't push its surplus to dealerships, as the oversupply would tank new car prices and margins. Rental companies became that private outlet where the big three automakers could dump their overproduction and book it as sales. This was all a uniquely American problem. Toyota, Honda, Mercedes, and Volkswagen experienced nothing as ridiculous or self-destructive. They built to demand and never signed union deals where workers got paid to do nothing. This is why Japanese and German cars have held their value so well over generations, as they never got branded as cheap rental fodder the same way American cars did. The fundamental problem was that every wave of program cars coming back flooded the used market with hundreds of thousands of identical vehicles. This oversupply destroyed the normal depreciation curve. With so many used cars of the exact same model and year, their residual values collapsed, which only made the next buybacks progressively more expensive than the last. It also punished GM, Ford, and Chrysler's most loyal customers. Someone who had paid full price for the same car watched their investment lose value far faster than a comparable Honda or Toyota, for reasons they couldn't see or understand. The big three were effectively cheapening their own brands and products. and the idea that they could slowly drip feed these cars back into the used market to protect residual values was naive. There were simply too many cars. By the mid-2000s, American automakers began feeling the long-term consequences of their short-term tactics. The terms that had been so generous to the rental companies dramatically changed. Investors started to prioritize profit over volume, and the automakers started pulling back, lowering the guaranteed payments, raising the depreciation rates on program cars, and tying rental companies to minimum purchase amounts to claw back margin. Then in 2008, the entire house of cards collapsed. A spike in fuel prices sent the resale values of trucks and SUVs into freefall. Ford lost more than $1 billion on leases, and Chrysler shut down their leasing division entirely as its cars were worth so little that leasing was just no longer viable. Then the following year, GM and Chrysler both went bankrupt. In the midst of a complete industry meltdown, the unions surrendered. With every automaker on the brink, the choice was simple: give up Jobs Bank and keep some jobs, or lose every paycheck and pension. With the repeal of Jobs Bank, Detroit could now finally lay off workers and shut idle plants. With labor restored as a variable cost, overproduction no longer made sense. Surplus stopped being built, and the automakers no longer needed a channel to dump excess. At the same time, they were in no financial position to guarantee residual values, subsidize rental companies, and keep up the buybacks, so they all walked away. For the first time in generations, Hertz, Avis, Dollar, Thrifty, and Enterprise were on their own. But just because Detroit stopped guaranteeing residual values didn't make depreciation disappear. It just changed who had to eat it. That risk had to land somewhere, and it landed squarely on the rental companies, where it's stayed ever since. Today, virtually every Hertz, Avis, or Enterprise car carries no manufacturer guarantees. For most of the industry's history, Detroit had told these companies exactly what their cars would be worth and handed them a fixed artificial depreciation curve. Now nothing is handed out. Rental car companies have to forecast residual value all by themselves years in advance for hundreds of thousands of vehicles across 4 different markets, and eat the loss whenever they get it wrong. To understand why getting the residual value wrong is so financially crippling, we have to look at the debt structure. Fleets are bought with borrowed money, and the cars themselves are collateral, but it's not a one-time loan. The lenders give out a cash advance based on a fixed percentage of the fleet's value, which typically hovers between 70 to 90%, and the rental company puts up the rest. But the value is not set once and left alone. Instead, the lenders continuously track the value of the fleet as it ages against the present-day used car market to make sure that the cars never fall below the money they advanced in the first place. As long as the cars hold their value, the loan stays covered and the rental company pays its interest and principal on time, everyone sleeps fine. But the moment the fleet's value falls in the used car market, the math breaks. The cars are suddenly worth less than the lenders assumed, which means the loan is undersecured. The lenders are no longer protected, because if the rental company defaults and they repossess the fleet, selling those cars would no longer bring back the money they lent out in the first place. Thus, whenever the cars depreciate faster than estimated, the rental company must put up more collateral by adding more cars or more cash just to keep the debt in place and the cars under their ownership. It's identical to a margin call where you buy stocks on leverage, but then your position moves against you. Your brokerage demands more collateral to cover the shortfall, or else they liquidate you. And until you settle, they won't let you buy any more stock. The rental companies operate in the same exact arrangement, except their leverage is a parking lot full of the cars they need to make money. Yet when the used car market swings up, they thrive. During the 2021 chip shortage, used car prices skyrocketed. The cars that Avis and Hertz had been depreciating were suddenly worth far more than estimated. Instead of losing money on sale as expected, they made money. Avis's monthly per-car depreciation fell by 1/3, and it sold its fleet into a supply-starved, used car market for record profits. Hertz earned more than $1 billion in free cash flow doing the same, and for those few years, the rental business looked like a slam dunk. Whenever the used car market beats the depreciation that a rental company has booked, the difference is pure profit. But the market moves the other way just as easily. The most extreme cases were in the Great Recession and COVID. Under this lens, the fleet is a trap, and anyone who doesn't own the cars should have a better business. But the irony is that the asset-light, peer-to-peer car-sharing tech startups like Turo are actually worse businesses than the legacy rentals. Their pitches are all the same. You offload the depreciation, residual risk, liability, and capital requirements to individual car owners, and then make money taking a cut of every booking as a software middleman. On paper, this should be the perfect antidote where there's no fleet, no debt, and zero exposure to the used car, new car, and capital markets. Yet the public markets have rejected these companies 3 times in a row. Getaround went public in 2022 and was kicked off the New York Stock Exchange in less than 2 years. The company has since shut down its entire US business and operates in only a handful of European cities. Zoomcar was booted off the Nasdaq within 18 months of its listing and exists today as a penny stock. And Turo, after seeing both its rivals fall apart, quietly withdrew its own IPO. The problem is that the model just swaps one liability for another. Legacy car rental is a leveraged bet on used car values. The peer-to-peer model is a leveraged bet on insurance and liability, which gets extremely expensive when you put strangers behind the wheels of cars owned by other strangers. Every single trip is a potential claim with exposure on both sides of the transaction. Under this lens, Turo is closer to an insurer than a rental company, and its insurance costs don't scale, because every additional trip is another claim to pay. Thus, as Turo grew, its unit economics ran the other way as claims outrun fees. Getaround proved the same point from the other end. By owning no fleet, it was vulnerable to the insurance pricing set by carriers and regulators it didn't control, and cities legislated the company out of the dense, high-liability urban markets where it was supposed to thrive. The asset-light model is ironically most fragile, where the asset-heavy model is the strongest. At the end of the day, the one thing that everyone treats as a weakness for the legacy giants is the exact thing that keeps them alive. A fleet is a liquid, financeable, material asset. You can borrow billions against it, and when everything goes wrong, you can still sell it into an actual market to raise cash. The asset-light platforms have nothing of value, and so when the VC money runs out, there's nothing on the balance sheet except insurance liability. When you own nothing, you control nothing, and you can never guarantee the supply, quality, reliability, and pricing needed to bring a customer back.